What's going on, everybody? Jay Costa here. Welcome back to the channel. So if you were to tell me a year ago when I started doing these YouTube videos that my 3 most viewed YouTube videos would be all based on a home equity line of credit, I wouldn't have believed it. My first video, I went over basically my application process getting my home equity line of credit. My second video, I focused on a home equity line of credit compared to a cash out refinance. And my third video, I focused on whether or not you should use your HELOC to pay off your first lien mortgage faster. This is a strategy that's called velocity banking. So if you have any interest in any of those videos at all, I'll put the links in the description box down below. Definitely check those out. But on this video, I'm gonna focus on a specific part of the home equity line of credit, and that is the interest rates. But first, before I get started, you guys, I want to thank you so much for tuning in. As I said, my name's Jay Costa. I'm a local real estate investor and agent here in Northern New Jersey. And if you get any value out of this video at all, please hit the like button. Also, leave a comment in the comment section down below and let me know what your thoughts are on the HELOC in general, what your thoughts are on using a HELOC in this quickly rising interest rate environment, and also let me know if you have any questions about any of this stuff that I could possibly help you with. Now, onto the video. On all 3 of those videos, I got hit with the same question very often, and that is, how are the interest rates calculated on a HELOC? And with the Federal Reserve continuously bumping interest rates of the federal funds rate every single time they meet, now I think it's more important than ever to go over exactly how the interest rate is affected by these policies on a home equity line of credit. So very briefly, let's just go over what a home equity line of credit is. If you want a more in-depth description, check out my first video. I'll put the link up in the corner here or here. I forget which one. A home equity line of credit, or a HELOC for short, is basically a way for a lender to give you access to the equity of your home, basically like a credit card. You apply for the home equity line of credit, they send an appraiser, they have a certain loan to value ratio or a percentage of the appraised value that they'll give you, and then you basically subtract the amount that you owe on your first lien mortgage, and that's what they'll give you access to. It's not a credit card, or at least in my situation it's not, but they give you a blank checkbook, and they say any check from this checkbook will come out of your home equity line of credit, and basically you can use it for whatever you want. Now, some people see that as a great opportunity to use the equity of their house in order to invest elsewhere, and other people think that it is super, super risky. Now, I'm somewhere in the middle of that, where you could definitely use a HELOC as a great investing tool, especially investing in real estate, but you also need to be aware of the risks and the consequences of the money that you're borrowing. That's why it's very important to realize how the interest rates on these HELOCs work, as well as how future Federal Reserve interest rate hikes will continue to affect your HELOC interest rate. Now, each lender is going to be different, so please make sure that you know exactly what you're signing up for, but I will just share with you my general knowledge of HELOCs as well as my experience with my particular lender. So first, you need to know what a federal funds rate is, what a prime rate is, as well as what a margin is. The federal funds rate, just to keep it very brief and simple, is the rate that the Federal Reserve sets. We hear on the news that they raise it another 0.75% or 1% or 0.5%. That is the federal funds rate. And the federal funds rate has gone from a low of 0.25% a year ago, which is insane, and now it's up to 2.5%. Now, the prime rate is basically 3 percentage points higher than the federal funds rate. And this is what my HELOC is based off of, as well as what seems like most HELOCs are based off of. Now, you would think that your HELOC would be 5.5%, but that's not the case. There is obviously risk involved for the lender giving out these HELOCs, so you need to pay for that risk. So each lender is going to be different in regards to what they charge, but there's going to be what they call a margin or a spread in addition to the prime rate. In my particular circumstance with my lender, my margin was 1.04%. So that means that with the prime rate at 5.5%, as of now, I am paying 6.54% on any money that I take out of my HELOC. So it is getting up there. And this is something you need to be aware of going forward with the market and credit getting tighter and tighter. So here are my warnings to you with interest rates on these HELOCs going up so quickly. Number 1, don't buy any depreciating assets with your HELOC. I don't really care what you think after the last 2 years is going to go up in value. The chances are it is not going to go up in value. So do not buy any depreciating assets because you're taking good money and throwing it into bad money. Number 2, and this is kind of connected to number 1, don't use it to fund your lifestyle. Don't use your line of credit on bills Don't use it to buy something that you really don't have the cash to buy, because I don't need to go any further. It's very obvious how quickly your financial situation can turn drastically wrong if you're doing this. Number 3, don't use it for investment purposes. As much as you want to take your 100 grand of home equity and put it into stocks and put it into crypto by buying the dip, you will get burned by this. And this is not even to say that stocks or crypto won't go up. The problem is the timing. You will not be able to time the market, because even if you get it right once, where you buy at the right time and it just goes up, you need it to be right a second time when you sell that stock to pay off your home equity line of credit. So you need to be right twice, and I don't like those odds. Also, don't use it to consolidate debt. If you have a lot of credit card debt and you're paying 20% on this credit card debt, it may be very easy to think, oh, hey, I'll just take my home equity line of credit money, use that to pay off the credit card debt, which is 20%, and only pay the 5.5% or 6% on the home equity line of credit, and you're saving X amount of dollars. Yes, in theory, that is true. But the problem is most people don't have the discipline to make sure that they don't get themselves into that situation again. You need to figure out why you got into that credit card debt in the first place. Because chances are, if you pay off that credit card debt and use the HELOC and it's only costing you $150 a month, you're going to make the same mistake again with your credit cards. If you're disciplined enough and it was just a one-time thing where you had to use the credit card for an emergency situation, yeah, okay, maybe you want to do that in order to consolidate and pay off that HELOC as quick as possible. But like I said, chances are you got into that credit card debt for a reason, so you need to attack the root problem. The bottom line is, guys, please don't use your house as an ATM, especially in this environment where the Federal Reserve is telling you they want to slow down the economy. They think that specifically the housing market has been too inflated from all-time low interest rates. So just keep this in mind. Now, this gets to real estate, right? Does the Federal Reserve raising interest rates completely kill the idea of using a HELOC to fund a real estate investment? So the answer is yes and no. I would say yes on long-term investment properties. Back in the day, when you're on an upswing in the housing market and interest rates are super low, a lot of people would take the risk, taking money out of a HELOC at 2.5% or whatever it was, and using it as a down payment, or even just to buy a full investment property, 100% with no mortgage at all, just using their HELOC. But with interest rates so high already and getting higher, really probably, in my opinion, should not be using your home equity line of credit to purchase a long-term investment property, unless maybe you want to use it just for some rehab funds on a short time frame. You may still want to consider using it for a fix and flip project, and the reason for that is it is a short time frame. Like I said, I've always thought that HELOCs are great for fix and flip opportunities because you could use the money, you could pay interest only, and you have an exit strategy. It's very important to have an exit strategy, especially in this environment, in regards to using that HELOC and then paying it off. And with a short-term fix and flip, there is an exit strategy. You're taking it, you're buying the property, you're rehabbing it, and you're selling it. And then you're going to pay off the HELOC right away. With a long-term investment property, there is no exit strategy. So I'd really advise to make sure that A, you know your numbers, you're underwriting it, your underwriting is on point, and also make sure that you're taking into account future rate hikes. Unlike a 30-year or a 15-year regular conventional mortgage where it's not directly tied to what the Federal Reserve is doing, HELOC, I just explained to you how a HELOC interest rate is calculated. It is directly affected by what the Federal Reserve is doing. And I don't think that they're going to be deciding to reduce interest rates anytime soon, do you? It doesn't seem like it. So if your interest rate on your home equity line of credit that you're going to use on a fix and flip is 6%, let's say, I would do that underwriting and use like a 7 to 8% interest rate. Use the underwriting. You need more of a cushion in order to protect yourself from downside risk. That is it for today, guys. Thank you so much for watching. Let me know what you think in the comment section down below about HELOCs in general, about using it on investment properties, and what different types of investment properties. If you have any experience with it, share in the comment section. Also, if you have any questions about how any of this works, let me know. I would love to help in any way that I can, and see you next time.